Have you ever looked at a Forex chart and thought, what on earth made the US dollar move like that? Maybe the euro just took a nosedive, or the Japanese yen suddenly surged. And you're sitting there wondering what caused this move. Here's the thing, while Forex markets might seem chaotic, there's always a reason behind the move. And it all boils down to three key drivers, what I like to call the 3 M's of Forex trading: macro, micro, and monetary policy. Every major currency movement, whether it's a spike or a drop, can be traced back to one of these 3 factors. The 3 M's are the foundation of Forex trading fundamentals. Once you understand them, you'll see the market in a completely new way. In this video, I break down each of the 3 M's, explain how they impact currencies, and share how I personally use them in my trading strategy to make profitable decisions. By the end, you'll see how you can use this framework to level up your own trading. Before we begin, make sure you hit that subscribe button so you never miss a video like this and actionable Forex tips, and check out the links in the description for more resources to help you master Forex trading fundamentals. All right, let's get into it. Macro is where we start. These are the big headline-grabbing stories that can send currencies and markets into a frenzy. If you've ever seen sudden reactions to breaking news, a war, a political crisis, or a natural disaster, you've seen macro in action. Take, for example, when Putin changed Russia's nuclear doctrine. He announced a shift that could allow for a nuclear attack on Ukraine. That news sent shockwaves across the financial markets. Stocks and the eurodollar plunged as traders scrambled to react. It was a massive move. But here's the thing, it lasted less than 24 hours. After the initial panic subsided, the market stabilized and the impact faded quickly. This is how I approach macro stories, and this is very important for you to remember. I use them for quick, big moves. When a headline drops, the market often overreacts, and that's where the opportunity is. In the Putin example, I traded the plunge and made a profit, but I didn't hold the trade for long, just enough to capture the quick reaction, which is pretty much a 12-hour period. Macro moves are unpredictable and short-lived, so I'm always out of these trades quickly, and in my experience, they can last between 12 to maybe 36 hours. Macro events basically create short-term volatility. Geopolitical crises like wars or nuclear threats push investors into safe haven currencies like the Japanese yen or the US dollar. Trade wars like the US and China's tensions during Trump's presidency ended up weakening some currencies like the yuan and strengthened the US dollar. Natural disasters such as tsunamis in Japan can weaken the Japanese yen due to expected economic disruption. To trade macro events effectively, you need to stay informed, follow global news, and have alerts for breaking stories. Act quickly as the markets react fast to macro news, so timing is everything. You want to trade with tight stops because the macro moves can be very volatile. They're like the Forex market earthquakes, sudden, impactful, but usually short-lived. Next, let's talk about micro. These are the economic reports and data releases that we watch closely day to day to gauge how an economy is doing, whether it's performing well or poorly. This is where I find support for my shorter-term trades. Micro factors like the jobs reports or the inflation data usually influence currency direction for 24 to 72 hours. If U.S. inflation data comes in hotter than expected, the market might start speculating that the Fed will hike interest rates sooner. That drives the US dollar higher for the next few days, giving me a clear direction to trade. Key data points to watch include employment data, like the US non-farm payrolls report. A strong jobs report, for example, represents and signals economic growth, boosting the US dollar. Inflation figures are also another piece of very important data. Rising inflation might put a central bank to raise interest rates more quickly. Easing inflation might trigger them to lower interest rates more quickly. GDP growth also plays a role. A fast-growing economy typically attracts investment, strengthening the country's currency. Trade balances are important. A country with a trade surplus often sees its currency rise due to increased demand, whereas a country with a trade deficit usually sees its currency weaken. Micro factors drive short-term trends, but last longer than breaking news. For instance, if Eurozone inflation comes in stronger than expected, traders might anticipate that the ECB will raise interest rates, boosting the euro. On the flip side, weak GDP growth in the UK might send the British pound lower as traders adjust to slower economic expectations. To trade micro data effectively, it is important to track the economic calendar, and there's some really great ones out there. It's your cheat sheet for upcoming reports. They even label the high events, the low events, the medium risk events. Pay attention to those expectations. It's not just about the data itself, it's how the data compares to market expectations. Surprises drive the biggest moves. Be prepared for volatility, as economic reports, especially the big important ones, can often lead to sharp swings. For me, micro is all about catching those 24 to 72-hour moves that align with the short-term direction of the market. It's like riding the tide until the next wave comes in, the next piece of economic data comes in. Now let's move to monetary policy. This is the most important of the 3 M's. If macro is the firecracker and micro is the heartbeat, then monetary policy is the engine driving the long-term currency trends. Monetary policy creates the foundation for currency movements for weeks, months, maybe even years in some cases. Central banks like the Federal Reserve or the European Central Bank influence their economies using tools like interest rates or quantitative easing, quantitative tightening. This sets the long-term trajectory for a currency, because usually when central banks start to move interest rates in one direction, they do that for some time. And it's where I align my overall trade direction. For example, the Federal Reserve is lowering interest rates aggressively, while Japan keeps its rates near zero. The dollar might weaken against the Japanese yen. This isn't a move that lasts a day or two. It's a trend that can play out for weeks or months at a time. And I position my trades to follow the broader direction. I always try to be in sync with monetary policy. Monetary policy creates currency divergence, which is a key driver of forex trends. When you have 2 central banks that take opposite approaches, like one is cutting interest rates, the other one's not doing anything, it creates a powerful long-term trend. If the ECB loosens monetary policy while the Bank of England stands put, the British pound could soar against the euro. To trade monetary policy effectively, follow central bank speeches, statements, and all the news related to where central bank policy could go. These often contain hints about future policy moves. I talk about them all the time in my daily videos. Position for the long-term trend. Monetary policy trends take time to unfold, so I use them to guide my trade direction over weeks or months. Look for divergence, as the best opportunities come when you have 2 central banks that are moving in opposite directions. Monetary policy is my compass for the bigger picture. It helps me align my trades with the underlying market trends, giving me the confidence in my positions for the longer-term trend. It tells me whether I should be bullish dollars or bearish dollars. Now let's bring it all together. Macro events create short-term volatility. I trade these for quick profits and get out fast, usually big moves. Micro data drives daily trends, giving me the direction for 24 to 72 hours, for example. And monetary policy shapes long-term trends, guiding my trades over weeks or months. By understanding the 3 M's, you'll be able to decode market